Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we get started, standard disclaimer: nothing here is investing advice. Do your own due diligence. And today's episode is brought to you by MoneyMetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JesseDay to get a $10 discount on your first purchase. Today's guest is a legendary investor with a wealth of experience in the commodity space, the former CEO of Sprott US Holdings and the CEO of Rule Investment Media. Mr. Rick Rule, it's great to have you back on the show.
Jesse, thanks for the opportunity. I'm delighted to be here.
It's been a long time since we last had an interview. I believe it was the Vancouver Resource Investment Conference back in January. So I wanted to kick things off with your thoughts on the current state of the economy and financial markets. It's a very broad question, but what are the main trends and themes that you are currently paying attention to at the moment?
I think in the very near term, it's a challenging circumstance for most investors and speculators. I think we're beginning to see the delayed impact of higher interest rates around the world. I think, too, people continue to be nervous about the war in the Ukraine and newly concerned about circumstances in the Middle East. Two, there's a lot of political and social instability in the world. And there's a malaise in capital markets also as a consequence of higher interest rates. I don't need to tell anybody who owns long bonds about the impact of higher interest rates on the prices for the long bonds and disintermediation of the bond market. I think we're beginning to see a spillover of that into equity markets, particularly the larger equity markets, where rising interest rates reduce the capitalized value of income streams from dividends. All of those have conspired to produce difficult equity markets. Now, perversely, I love difficult equity markets. To me, a bear market is a sale. And what I'm seeing is that companies that I have wanted to buy for substantial periods of time, or at least stocks I've wanted to buy for substantial periods of time, but I've been unable to buy as a consequence of low prices, have corrected. So for me, as usual, the worst of times becomes the best of times. For people who don't have my patience, or for people who don't do the work to establish value, but rather practice the got a hunch, bet a bunch technique, these are and will continue to be tough times.
I want to ask the same question, but shifting to commodities specifically. So, what are your overall thoughts on commodities here? Where are you currently looking for value in the commodity space? And perhaps more importantly, where are you exercising caution?
I'm not exercising caution. I'm attempting to place capital. I note that the last time we visited, we spent a substantial time talking about uranium. And I said that we would pass into uranium bull market when the pace of Japanese restarts accelerated. That happened, and we're in a uranium bull market. Uranium is outperforming other commodities. I would use this not so much as an I told you so, but rather to reacquaint your audience with the fact that commodities that are out of favor are the commodities that you buy. One really, truly hated commodity right now, one that's disappointed investors for at least 3 years, is silver. So I'm starting to look for silver stocks. I like them when nobody else loves them. That isn't to say that you exit the uranium stocks yet. I think that uranium has at least a year to go in a bull market. If you're there, be right, sit tight. If you're not there, if you're coming into the space, you need to exercise some caution now. It's not a no-brainer, like it was the last time you and I talked. As to the broader question around commodities, I continue to be attracted to precious metals because I believe that the policy response to an economic malaise is highly inflationary. I see government deficits everywhere, even as I see it being more difficult to service those deficits with higher interest rates. I think the way around the political promises that have been made is to inflate away the net present value of the government's obligations, which is to say inflation. I saw it happen early in my career in the 70s, and I think I'm going to see it happen again. So I'm attracted both to precious metals and to precious metals equities, although some patience will be required. I'm attracted, too, to industrial materials, although I suspect that the next year will be challenging in the industrial materials market. I don't think a Chinese rebound has happened anywhere near as quickly as people would have preferred. And I think that you are seeing the delayed punch to the economy affected by higher interest rates, as well as caution in continental Europe as a consequence of war, and newly established caution around the disputes in Israel and Palestine. I believe longer term, however, that the market for industrial materials will return and will return in spades. I think that's true because I think we've underinvested in productive capacity for a very long time. And as world population growth continues, and as the material ascent of humankind continues, that the ability to produce that we currently have around several materials will be insufficient to meet current, let alone future demand. I continue too, Jesse, as I was in our last interview, to be particularly bullish around fossil fuels, oil, gas, coal, things like that. The big thinkers in the world, the Justin Trudeau's, the Joe Bidens, my favorite energy physicist, Greta Thunberg, people like that to tell you that the era of fossil fuels is over. I would note, Jesse, for your listeners, that humankind has now spent almost $5 trillion US in 40 years on alternative energies, and we've reduced the market share of fossil fuels from a high of 82% all the way down to 81%. $5 trillion has reduced fossil fuels market share by 1%. What does that mean? Oil and gas, stronger for longer. Coal, stronger for longer. Uranium, stronger for longer. Note, I'm not against alternative energies. I want to put them in their place. I'll add them to my portfolio when they're economic. But compared to, oil and gas and coal, the place in the sun will continue to be enjoyed, I think, by fossil fuels to the benefit of investors.
Absolutely agree with you there. I'm a big bull on oil and gas as well. I had our mutual friend Lobo Tigre on the show a couple of days ago, and he was talking about gold equities and explaining why at the moment he's still sitting on the sidelines. He thinks that a higher for longer interest rate environment could provide headwinds for gold, and he's not investing in equities yet. Do you have the same mindset at the moment, or are you finding attractive valuations currently in the gold equities?
I have different needs. Lobo has to serve an audience that's impatient. Lobo has to perform on a monthly basis. Lobo has to serve an audience that pays him a fairly reasonable amount of money for what amounts to trading advice. I'm not a trader. I'm an investor. I'm a speculator. It's odd, Jesse, and I've said this to Lobo. By the way, I have huge respect for Lobo, who's also a personal friend. It's odd that as old as I am, as little time as I have left on Earth, I've become very patient. I think in 5-year terms. The consequence of what Lobo has to do is that he has to think in quarterly terms. I think he has to do what he has to do, and I have to do what I have to do. I love circumstances where I think there's a high probability that I'm right, but the uncertainty revolves around time. I phrase it as asking a question where the answer begins with when, not if. I prefer when questions. Lobo, at present, given what he does for a living, can't afford when questions. I have a phrase I like to use that says inevitable, but not necessarily imminent. I like things that are absolutely cheap. I like things that are relatively cheap. And the way you get them is to buy asset classes that are out of favor, particularly with impatient competitors.
And are energy equities looking cheap to you at the moment? Obviously, there's this argument out there that we're headed for a recession that's going to bring on demand destruction when it comes to oil. And so the equities could face further corrections from here. What are your thoughts there? And you mentioned coal. I find coal very fascinating because it's something that's not brought up a lot. And we know that both India and China are massively building out their coal capacity. And that seems very bullish to me. So where can your average investor look to invest in coal? Because I know a lot of that is private as well. There's not as many publicly traded companies as with the precious metals, for example.
Well, there are actually there's a fair number of coal companies. Investors to cover the waterfront would have to go to Australia. But Canadian investors in particular, I think should look at Teck, where the unbundling of the coal assets will provide a coal-related catalyst. That's a near-term theme that's playable. The market has discounted the value of Teck's coal assets, but the industry hasn't, which is why Glencore threw a takeover at them. Noted investor in Canada, Pierre Lassonde, is attracted enough about the assets that he's made an informal bid for the coal assets of Teck. So I suspect that the easiest way for Canadian investors in particular to play the coal space with a nearer term catalyst would be Teck Corp, not primarily a coal producer, but one where coal affects the immediate outcome disproportionately. I'm more attracted, frankly, to the oil and gas business because it's a bigger business, it's a better business, and it's easier to play. In that context, the biggest and the best name of all is headed a little lower in the near term, which is to say ExxonMobil with their recently announced takeover of Pioneer. This will put pressure on the stock. I think for people who have a 3 to 5 year outlook, as I do, that's a wonderful opportunity. I'm not saying it won't continue to lower for the near term in the context of weaker economic conditions, but this is a premier deployer of capital, firing on all cylinders upstream, downstream, refining and marketing, everywhere. Other names that I think American investors might want to look at are American natural gas names. In particular, I would say Devon Energy, the big producer in the South and the West, and Equitable, the big producer in the Marcellus Shale. The dichotomy, the delta, if you will, between U.S. domestic natural gas prices and global energy prices is one that's going to be eaten up by liquefied natural gas, American liquefied natural gas, and those two names will be prime beneficiaries. Canadian oil and gas investors have an even broader menu to look at, with the caveat that the Prime Minister of Canada and the Laurentian elites hate the oil and gas business. The market, however, is bigger than they are. I don't think they realize that yet. So names for Canadians would include Arc Energy, Freehold Royalty, Prairie Sky Royalty, Peyto, Birchcliff, Tourmaline. There's just a plethora of names in Canada. Buying a basket of those names, if you are prepared to own them for 5 years, if you're prepared to stomach volatility, and if you are willing to subject yourself indirectly to the hatred of the Eastern Canadian press and the political hatred of the Laurentian elites, I think you'll do extraordinarily well in terms of capital gains and dividends, which might ease the pain of being unpopular.
I wanted to talk a little bit more about uranium and specifically Kazatomprom, because it seems that the management at the moment is a bit of a revolving door. We've seen 7 members of senior management resign in 5 months. You've mentioned before you think Kazatomprom is one of the best run uranium companies out there. Do you still hold that view? Is this all being blown out of proportion? And what are your thoughts on these resignations?
I don't think it is being blown out of proportion. I can't explain them. I have some contacts within the company that I've been directing questions to without much success. That much management turmoil, particularly some of the resignations who I believe to be key people, suggest that there is political turmoil within the ranks of Kazatomprom and also within Kazakhstan. And unfortunately for me, I don't understand that turmoil. Which makes me even more concerned. Make no mistake, Kazatomprom is the biggest and most important uranium company on the planet. They have substantial room for growth, both in terms of restarting shutdown deposits and also starting greenfield deposits. They're the lowest cost producer in the world. They're the largest producer in the world. They have substantial management expertise, at least among the younger managers in middle management. But it would appear that there's a political schism between the political elite in and out of Kazatomprom and the management team at Kazatomprom itself, which is troubling to me.
Let's shift to the online event you're going to be hosting on streaming and royalty companies. It's going to be the day after this interview is released. That's October 21st. So I'm going to put a link in the description below for anybody who wants to take a look. Now, I personally use streaming and royalty companies as my main vehicle for investing in the silver and gold space. I personally see the risk reward set up to be more favorable than individual equities, especially because I don't really know the gold and silver space deeply, and I don't have the expertise or the time to look into individual companies. So can you first explain what the royalty and streaming model is for those who are totally unfamiliar and walk us through why investors should consider it?
Jesse, an argument can be made that some investors should construct their entire portfolio out of royalty and streaming companies. Royalties are an interest in a mineral deposit, an economic interest in a mineral deposit, where you get a piece of the production off the top. You aren't responsible for capital expenditures. You aren't responsible for operating expenditures. So after G&A, your gross is your net, which is a very nice thing. Not being exposed, or rather getting a check without getting a bill, in effect, is a very nice thing. A stream is different. A stream is an economic interest in the output or throughput of a deposit. You pre-buy the right to receive a product stream at a fixed price for a fixed period of time. But again, you have no capital obligations. You have no operating cost obligations. Your obligation is the contractual price that you have agreed to pay for the material. These are durable, high margin, very predictable, very valuable businesses. And an argument can be made, if you're willing to give up some of your upside in a raging bull market, that the fact that you have very little operational downside makes these extraordinarily attractive investments. And I have actually constructed portfolios for people, including a family office client when I was at Sprott, that was 100% royalty and streaming companies in the mining and oil and gas space, and wouldn't discourage other investors and speculators from doing the same thing. The boot camp will cover royalty and streaming in depth. For those people who haven't attended our boot camps before, they are 8.5 or 9 hour long online explorations of specific topics. We try to give people an overview of the topic from an industry expert, in this case, Doug Silver, one of the inventors of the mineral royalty business. And we try to talk about as many aspects of the royalty and streaming investment business as we can. We have previously covered uranium, a highly successful boot camp, silver, and electric and battery metals. Note that it is impossible to get and absorb all of the information that we're going to offer in 8.5 hours in 8.5 hours. The consequence of that is that the boot camp will be available for people who have subscribed online for 12 months. Although I put on these boot camps, I have to watch them an average of 4 times each to absorb all of the material too. Note that the cover charge for admission is $99 and comes with an absolutely gold-plated money-back guarantee. If for any reason you think that we didn't deliver the price of your admission, email us and we'll give you your admission back. We would like you to tell us how we failed, how we can serve you better, but there's no requirement. There's no questions asked. If you give us $99 to attend the boot camp and you didn't think you got your $99 worth, you'll get your $99 back from me personally.
That's about as good a deal as it gets. I want to continue on the royalty and streaming theme for a moment here, because we've discussed on the show before about how you evaluate mining equities, but obviously royalty and streaming companies differ in many ways. So how do you approach evaluating one of these companies, and what are the main metrics you look at before deciding to invest?
Well, they're much easier to construct net present values for, because you don't have to take into account cost inflation, as an example. You don't have to take into account wage settlements. You don't have to take into account sustaining capital investments or new project investments. These are purely an economic interest, either in the deposit itself or in the product stream for the deposit, which means that you construct a matrix of commodity prices that you expect in the future. I use the forward strip as an example. And then I use a discount to the forward strip, and I use a premium to the forward strip, so that I can construct a matrix of price expectations. And then I construct models around the expected output of the mine in question and attempt to arrive at a rough net present value. If the company is selling at a reasonable discount to what I think it's worth, I have a buy. If, by contrast, the company, as it often happens, is selling at a large premium to the net present value of those free cash flows, I sell. The second thing that you look at is investment acumen, or what in the oil and gas business is called the recycle ratio, which is to say you quantify the track record of the management team at redeploying the capital that they get from the payments that they receive from the mining companies into new investments. In other words, is the company growing, or is it at least maintaining its revenue base? And is it doing so efficiently? If you look, as an example, at the recycle ratio around Franco-Nevada going back 30 years, not only did these guys start life with an incredible asset in the Carlin Trend in the United States, where they paid $2 million for an asset that's generated $1 billion in royalty revenues, but they've done a wonderful job reinvesting that $1 billion to build what is truly the most formidable mineral royalties portfolio in the world. So you look at net present value, and then you look at what I call recycle ratio to give you some sense of what the asset is worth and what the probability is of the growth of that asset in the future.
I want to talk about battery metals for a moment here because you mentioned you did a boot camp on that as well. I personally am very averse to battery metals, and I think it's an emotional reason. I think it's because I really don't like what you call the big thinkers who are putting forth all this legislation to mandate EVs and to mandate renewable energy, the green transition, etc. So I find it hard to stomach in investing in battery metals. Obviously, maybe I'm leaving opportunity on the table here. How do you currently view the battery metal space? Is it mainly lithium that you're looking at there, or are there other metals you think present opportunity, nickel, cobalt, etc.?
I've personally moved on from lithium because I believe that markets work. The fact that lithium prices have quadrupled in 5 or 6 years brings a market response. And we're seeing a market response. We never had a shortage of elemental lithium. What we had was a bottleneck in capacity for lithium chemicals because lithium demand increased so quickly that the fabrication of the final products became a problem. We're seeing a circumstance now where we are debottlenecking existing supplies at the same time that we're increasing new supplies. And if, and I say if, not necessarily when, the oil and gas industry perfects a technology around extracting lithium from co-produced saltwater brines in oil and gas extraction, then the lithium business is swamped. Notice that I said if, not when. With regards to the furor around battery minerals generally, as you know, Jesse, I try to avoid furors. I'm attracted to electrification, not because Mr. Biden likes it or not because Mr. Trudeau likes it, but rather because 1 billion people on Earth currently have no access to electricity. And I think in the next 20 years, all of those billion people are going to have access to primary electricity, which means that the demand for all of the economies, all of the materials around the electric economies are going to increase. I don't think this is as much about electric vehicles as it is about the urbanization of people in India and Malawi and Indonesia. And I think that's all a good thing. I think distributed storage, which is to say the ability of people to generate electricity and store and use electricity independent of centralized grids, is an important theme too. And in order to do this, we are obviously going to have to access battery technology, whether or not Mr. Biden approves.
Well, I want to talk about Battle Bank now. You're involved in the banking industry. Now, to me, the banking industry seems like a cartel of insiders, at least if you look to the bigger players. I recently had G. Edward Griffin, the author of The Creature from Jekyll Island, on. And, what he has to say about the banking industry is obviously very dark. I'm wondering what your experience has been in your endeavor with Battle Bank. Have you faced any pushback or challenges from inside the industry?
I need to start, Jesse, by saying that what I really am successfully in my lifetime has been a used money salesman. I spot market anomalies, and that's what I do. So I'm by nature a banker. That really, truly is what I do. And I'll begin to answer your question by saying there's no way in the world that I can compete with the big banks. But there's also no way in the world that the big banks can compete with me. What is for them a crumb is for me a banquet. Beginning in 1998, I backed a group of people at a bank called Everbank. We started it from scratch. It was one of the first online banks in the United States. We grew the bank for 14 years, from zero to $28 billion in deposits, and then sold it to TIAA-CREF. They didn't need the innovative deposit products that we created because they had 1.5 million of their own members that they wanted to service. So the consequence of that, although the bank was a good investment for them, they left behind the 250,000 customers that we had attracted to Everbank. I am backing the same team now to, in effect, recreate a better Everbank called Battle Bank. The things that set us apart from the big banks that dominate the investment scene, particularly in Canada, but also in the United States, is that we won't have a plethora of deposit products, many of which, by the way, don't pay you interest. We'll have one checkings and savings account, a high yield money market fund. If you want to write checks on it, God bless. If you don't, no problem. We will also have money market accounts and CDs available in 22 currencies, just like we did at Everbank. If you're a Canadian businessman and you need to maintain deposits in Canadian dollars and US dollars, and you need to exchange between the two, we will do that for you, and we will do it for you cheaply. That was the primary ingredient in the success of Everbank, innovative deposit products treating the customers well. What we're going to do differently this time is on the lending side of the balance sheet, the asset side of the balance sheet, we've identified a wonderful market niche that the big banks don't know exists. That's gold. If you hold gold in a segregated account, we will loan you money against your gold. Let's say you own $1 million worth of gold. You need $500,000 in liquidity as a down payment on a duplex or something like that. We will give you a credit line secured by your gold so that you can access the equity you have in your gold without having to sell your gold or silver. There are literally billions of dollars owned in Canadian and American accounts, segregated accounts in physical precious metals, gold, silver, platinum, and palladium. And if you have that in your own portfolio and you want access to the liquidity, whether or not you use it, Battle Bank will be for you. The other thing, Jesse, that we're going to do, and I'll get around to the question about the big banks after my commercial. The other thing that we're going to do for you is we are going to let your IRA be your IRA. It turns out that you can construct a product called a checkbook IRA, where your IRA owns an LLC, which owns or can own a franchise, a private business, a duplex, a fourplex, and you can operate it. It never occurred to me that I could own, as an example, an owner-operated revenue property in my IRA. It turns out you absolutely positively can. The big banks don't want you to do this because they consider your IRA to be a captured customer for their financial products. At Battle Bank, we believe your IRA is your IRA. Getting around to your question, the regulations around establishing a bank are often regulations that favor the incumbent. It would be very difficult these days to establish a $10 million bank or a $20 million bank. That's both because the banking regulators don't want the strain of failure and because the FDIC guarantees deposits, and so they want a stable institution. But it's also a barrier to entry. A Battle Bank will be a $150 million bank. So it is a bank that has the scale necessary to fund the regulatory burden that's been imposed on us by the banking community. I need to say, I am absolutely unafraid of competition from Bank of America, from Citicorp, from JP Morgan Chase, from HSBC, from the Royal Bank of Canada, from the Bank of America. And by the way, I'm a customer personally of most of those institutions. I would describe my relationship with most of them, and I'm a good banking customer. I would describe my relationship with them as sullen. And I hope that people's relationship with Everbank is glowing, is ebullient, as opposed to sullen. Now, the other thing I see right now, Jesse, that's just hugely amusing to me is that the business that I came into business with was oil and gas lending, senior revolving credit facilities in the oil and gas business. It never occurred to me at age 70 that I could come back into that business. That business was owned by RBC, by BMO, by JP Morgan Chase, by Wells Fargo, by Bank of America. But the oil and gas business is politically incorrect. And these guys are backing out of the single best lending business I know. So I look forward to Battle Bank being an eager participant in senior secured revolving credit facilities for the oil and gas and perhaps for the mining business, precisely because the big banks, who by their nature should own this business, are retreating from it voluntarily. I make a joke with my colleagues at Battle Bank that even an old, fat, bald 70-year-old like me could win the 100-yard dash if I'm the only guy in the race. And that seems to be what's happening in oil and gas lending, much to my delight.
Well, I'll tell you, I've been having a heck of a time with the banking industry here as a new resident of Serbia. So hopefully someday you can bring a Battle Bank out here and help me out. That'd be great. Before I let you go, I want to end on an educational topic because you provide such great education through Rule Investment Media. In addition to these boot camps you put on, you have a wealth of free videos on your YouTube channel as well that I highly recommend people check out. So I wanted to ask, what do you think you've seen recently in terms of the biggest mistakes that investors in the commodities space make, and how could people correct those mistakes?
Jesse, I've now graded over 80,000 portfolios in the last 5 years. Note to your viewers, any of you who go to ruleinvestmentmedia.com can submit their natural resource portfolios and I'll rank them for free, no obligation. By the way, I learn as much out of that as they do. The most frequent mistake, well, people make two frequent mistakes. The first is that most people are too speculative. In a resource bull market, the beta, which is to say the extent to which resource stocks outperform the broad market, is generally large enough that people don't need to speculate to profit. Most people should confine their allocations to the biggest and best natural resource companies that exist and simply enjoy demographics and time being on their side. Speculators own too many stocks. I ask people who own speculative stocks to own the number of stocks which corresponds to the number of hours per month that speculators are willing to spend understanding the companies in their portfolio. It is not uncommon for people to submit lists of stocks that they own to me that are 40 stocks long or 60 stocks long or occasionally 100 stocks long. The probability that the owners of those stocks have spent 100 hours in the past month familiarizing themselves with the companies, reading the proxies, reading the annual reports, reading the 43 101s, the probability of that is nil. Too many speculators own stocks because they saw it recommended in a newsletter. They say, got a hunch, bet a bunch. That doesn't work. You have to do the work if you're going to own speculations.
Absolutely agree with you there. Rick, it's been awesome chatting with you again. As mentioned before, I will put a link in the description to the boot camp you're doing on the streaming and royalty companies. That event will be taking place tomorrow after this video is published. So anybody interested in checking it out, you can do so. I'll also put a link to Rule Investment Media where people can submit their portfolios. And once again, it's been an honor, Rick. Thanks so much for coming on and sharing your knowledge with our audience.
Jesse, I always enjoy these sessions, so I look forward to participating in them in the future. Thank you for this opportunity.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Link is in the description below. Use coupon code JesseDay to get $10 off your first purchase, and I'll see you guys on the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.